What do these three people have in common? Britney Spears, Charlie Sheen, and Mel Gibson. Well, you don't know what they'll be worth in 1 year's time. They're highly risky. In 1 year's time, they could increase the number of recording or movie contracts that they have, or they could go downhill and the opposite would occur, and therefore they'd be worth much less. I want to take Britney Spears rather than the other two as my example. And what I want you to imagine is that you're married to Britney Spears, and the value of Britney's back catalogue of recordings and her future recordings give her a current value known as the spot price or the cash market price, S, of $100 million. That's great, but she's also highly volatile, i.e. she's risky. In a year's time, she might be worth much less, or she might be worth much more. You've been married to Britney for some time, and you can take this volatility in her behaviour and therefore in her cash market value. But you think that recently she's probably got a little more volatile than average. So you're thinking about the possibility of divorce and what you might get in 1 year's time in the settlement. Now, Britney's value in 1 year's time could be much higher, a cash market price of 140 million, or it could be much lower, a cash market price of 60 million. So she's a risky asset. You don't like this risk. What you would like is a guaranteed minimum acceptable payout of K equals $100 million in 1 year's time if things go bad and Britney's only truly worth $60 million, or if things go well and Britney turns out in the cash market in 1 year's time to be worth $140 million, then presumably you'll be even happier and you'll wish to stay with Britney. What kind of contract will ensure the outcome that you wish? Well, Britney's manager is going to offer you the following put contract, which says if Britney is worth 60 million in 1 year's time, he will give you the strike price of 100 million if of course you also deliver Britney to him. This is called exercising the put option contract, and it means as you deliver Britney to Britney's manager, you are effectively getting divorced, and the settlement is the known strike price of 100 million. So you've fulfilled the first part of your contract. On the other hand, if Britney is worth 140 million in a year's time, then Britney's manager will still only give you the strike price of 100 for Britney. So you'd be silly to deliver Britney and get the strike price of 100 million for her when she's actually worth in the cash market 140 million. So you don't deliver Britney, you don't exercise the put contract, you don't get divorced, and I'm not saying you live happily ever after, but you certainly don't get divorced. How much would you have to pay Britney's manager today in order that he agrees to give you this particular contract, which is known as a put contract? As you can see, it's a form of insurance for you. The amount you'll have to pay for this put contract is about $5.5 million, which may sound a lot, but remember, you're insuring Britney for a minimum of $100 million, the strike price. Therefore, the insurance is only costing you 5.5%, which seems pretty reasonable given the volatility in Britney's underlying behaviour. The analysis we've just done applies to any of the three characters, Britney, Charlie or Mel. If you happen to be married to one of them, Their current marketable value is volatile. They're risky assets. Normally you tolerate the ups and downs of relationships. But if your partner becomes more volatile, it may be time to contemplate the possibility of divorce in a year's time. If so, you need to buy a put option today to guarantee a floor value in the divorce settlement. Unfortunately, if your partner is Charlie Sheen, who's the most volatile of the three, you'll need to pay more than the 5.5 million for the put option on Charlie Sheen than you did for the put option on Britney. I'm sure you know why. The higher the volatility, the more likely he is to end up being worth nothing in a year's time. So the insurance for Charlie Sheen will cost you more than the insurance for Britney, who's rather a calm, sensible girl, really. If you want to know some more about options, then you could look at the two books, Investments and Financial Engineering by Cuthbertson and Nietzsche. That's all for now. Bye.